Check, please.
Hey, welcome back to Everything Money. We're glad you joined us. In this video, we're going to talk about AT&T, the ticker symbol T. We'll talk about their debt, their dividend, people who love this company, and how it hasn't really moved in 30 years. We'll show you some of the financials, our thoughts on this company, how to day trade it, and what you should be paying moving forward with some assumptions using our software and our stock analyzer tool. I give you Paul Gabriel. Paul, give me your thoughts on this.
All right, so AT&T, there's a lot of chitter chatter out there about AT&T being a value play, and my biggest concern about AT&T is the debt. And they're doing this whole spinoff and all these things that are happening with Discovery, all that stuff. Isn't it Discovery? It is.
Yeah.
AT&T is growing a lot with their HBO Max. That's a huge growth potential for them. But the debt is still an issue of mine. Now, I was reading on AT&T's recent earnings call, and the CEO's goal is to take their debt to EBITDA from a ratio of 3.17 now to 2.5 at the end of next year. To me, the biggest issue for AT&T is this debt. They're a slow growing business. They're not going to grow that much. They'll be lucky to get mid to high single digit growth numbers. Lucky.
Yeah.
The biggest issue is their debt. So another thing I want to show you guys is this is the earnings estimates for AT&T EPS over the next 5 years.
What's EPS for our new users?
Earnings per share.
Okay.
Great. So it's the earnings of the company divided by the number of shares outstanding. I mean, look at this. It's barely growing.
Oh, no.
I mean, that's the way it is, guys. It's such a big company. So how are you going to make your money off of AT&T? Hopefully paying down debt, making the balance sheet better, and buying back shares. Buying back shares will drive this earnings up because earnings per share is earnings divided by number of shares. So as this number decreases, because they're buying back shares, it drives this number up and therefore makes the stock go up as well. But we have to make sure that the company is smart by buying back their own shares, right?
Yeah, so this used to be a huge dividend play. This thing hasn't moved. Mo's called it a dinosaur in the past because it just doesn't go anywhere. But the dividend is going down with this merger with Discovery,
which I'm very happy about.
Explain that to me. Explain that to me again, because I don't quite get it. As an investor in AT&T, I want that dividend.
Well, you want the dividend, but at the debt levels that they're in, you want them reinvesting in themselves, having a better path forward, not just paying out cash to you, especially because Paul talks about it all the time. It's very tax inefficient. And
the reason dividends are tax inefficient are?
They're double taxed.
You're double taxed because the company's already paid taxes, and when they pay out the after-tax earnings to its investors in the form of a dividend, you then pay a tax on top of that. So whenever I hear people say like, oh, we got to tax dividends higher, it's like, it's already been taxed.
Yeah.
It's already been taxed once.
When they came out in July of last year and said, we're cutting the dividend, I was like, thank the Lord. You guys figured, you guys did something right finally.
But
that's funny, Mo, because a lot of people were find that was the last straw.
It's funny. That was the first time that I met Nicole's father. First time I walked in, he's like, I hear you do stocks. What's with the AT&T dividend?
Is it really?
Yeah. I'm just like, okay.
Well, and that's the funny thing. They're keeping the dividend up because they need to attract people to their stock. A lot of companies will increase dividends so it attracts people to stock. But we're trying to teach that, hey, it's not necessarily the best thing for the company. In fact, companies that are trying to attract people by paying a higher dividend are probably companies that are selling for value territory. They should be buying back their shares. That would be much better for the investor. Can I please show an example, Seth?
Oh, please do.
Would you mind? Okay, so let me pull up my notepad so I can get a clear screen. So let's say a company makes $100 overall, and there are 20 shares outstanding.
I was going to say the $100 I was going to say, is this Neo? But that was a joke. They make over $100.
$5 per share.
Go on.
Now, let's say the average company sells for 15 times its earnings per share. That company's stock should be $75. So makes 100, has 20 shares outstanding. Each one is $5 a share, 100 divided by 20. Then you multiply by PE of 15, you get $75 per share. Nice and easy, right? Okay. Now, let's say they still make $100 because it's a very low growth company. Let's say they don't grow at all. But now they buy back 5 of their shares. Now they're divided by 15 shares. That's now $6.66 per share. So it's the same overall earnings, but they've bought back shares. Now they're making 6.66 times 15. That makes it a $100 a stock, $100 per share in price. So now 75 to 100. This is the benefit of this. You've got an increase of 33% in the stock value. Okay, and you can keep riding that in the future because you haven't been taxed on this until you sell it. And that's the benefit. And that's what I wish AT&T would do with their cash. I wish they would cut their dividend completely and focus on paying down debt and buying back shares. If they did that, I would be a happy camper. I have not looked at AT&T in a while. And this is their revenue. And guys, let me show you their revenue. I already showed you guys their EPS growth. Here's their revenue growth assumptions for the next 5 years. 153 to 173. It's not a ton. $20 billion. I mean, we're talking about like literally 2 or 3 percentage points a year. So this is going to be a very slow growing company. The way they're going to give their value to their investors is making the balance sheet better and buying back shares.
When you guys talk about this, it just makes me think I don't ever want to really own this company. I mean,
well, not necessarily. I mean, listen, what I always tell people is, if you take a dump in a bag and I can figure out a way to sell it for $2, so I'll pay you $1 for it today to sell it for $2 tomorrow. I don't care. I mean, that's the thing of an investor. A good investor will sit there and say, there's a price for everything. Now, sometimes the price might be negative, which means you need to give me a check to take it. I literally once had a real estate deal where people asked me to buy it. I said, yeah, give me a check for $100,000. I'll take the property for free. And they're like, why? I'm like, because it needs so much work. There's still a price for it. That price is negative though, because I have to be paid to take the asset. Yeah. And by the way, back in 08, 09 with the housing crash, my lowest price paid for a house, I got a check at closing. Paying cash for the house, I got a check at closing because of how low house prices got. I got a check at closing.
They're literally paying you to take it.
They literally paid me a check because, granted, it was a tax credit, but the whole point was I paid $1,500 for the house. The tax credit was $2,500. I got paid $1,000 at closing to take the house.
$1,500 for a house.
Yeah, and that house is now worth 80 or 90 grand. I put 30 or 40 into it, but it's still. But I've been collecting rent for 12, 14 years also. Yeah. So that's what we're trying to teach here. We're trying to teach this. We're trying to teach the process of, let's look at AT&T on our 8 pillars. It's probably not the best, is my guess. Yeah. Okay. Shares outstanding. I wonder if this had to do with some sort of acquisition. They increased shares by an acquisition. I'm not saying it's good. Look at this. This is the debt level right here. Long-term liabilities divided by 5-year free cash flow. 11.6 times. That's a lot, guys. And especially for a company that has so much debt, if rates start going up and up and up, you're going to see this earnings number just start to collapse. Right? So that's part of the issue. But look at this price to free cash flow.
Did you just do a Verizon video for the community, Paul, or was that you, Mo? I wonder, is there a comparison to that other company, Verizon? I mean,
I don't know.
I don't think it was me.
Okay,
let's see Verizon's debt though. That's it. Let's just bring up Verizon's debt.
Yeah, Verizon does have. Last time we looked, I remember they have a fair amount of debt.
Well, their debt, their free cash flow is down a lot for some reason, but their long-term liability. And by the way, Berkshire Hathaway loves Verizon.
They love Verizon,
and I don't know why. So either way, this is where we look at low return on invested capital, guys. This is a company where the way you're going to make your money is for you to think to yourself as I get my dividend and they're going to buy back shares. I mean, let's go to Stock Analyzer tool. So this is what we created. And for those who belong to our community, who get the software, and more on that in a little bit, this is why it enables you to go in here and make these assumptions, because every investment is the present value of all future cash flows. And we don't know the future. We can only make assumptions. Those earnings per share and the revenue growth I put in there before that I showed you, that was from analysts who very much keep track of the company. But again, take that with a grain of salt. They also probably belong to investment banks and banks that want to do business with AT&T. So they're probably going to be more optimistic. Seth's mom used to work for AT&T, right, Seth?
50 years, yeah.
Does she still have AT&T stock?
I don't think so.
Really?
Actually. Well, her advisor got her into some high flyers, which...
Yeah, those are doing well now.
Yeah.
This whole channel, this whole software right here was created because the users requested it and we delivered it. They said, listen, we want to start analyzing stocks without having to wait for you. We kept getting all these requests. So we made this software. This is all created. In it, you get the 8 pillars, retirement calculator. And by the way, go look for our videos on retirement calculator. It is phenomenal. Stock Analyzer tool, which you just saw. 8-pillar portfolio, exclusive video content. Every day we release videos to people who belong to our community. And you can belong to it on your phone or on desktop, either one. It is an app. Watch list, huge. You look at AT&T. I can sit here now and say, I want AT&T at this price. Let's say $19. I add to my watch list. If it hits below, notify me. Boom. So now when AT&T goes below $19, I'll get a notification on my phone and over email and the app telling me to go buy it. You get all of that plus everything coming up here. And the biggest thing, our community. Guys, investing's hard. Investing is hard alone. This community has over 6,000 people in here that you can sit here and talk to every day about all these. You can go in the chat, look up AT&T. It'll tell you exactly where it was mentioned in all chat history. You go there and start having a conversation about AT&T. Do 1/10 of the work, have everybody else do a collective effort on the work. This here, if it can increase your returns by 1 or 2% a year, or decrease your losses by 1 or 2% a year, it will lead you to hundreds of thousands and probably millions of dollars extra in retirement. No brainer. This is only $1 per day. That's it. $1 per day. 2 ways to sign up. Everythingmoney.com, or for our international users, patreon.com. Sign up. $1 per day gets you all of this. Is a no-brainer. All right, so I'm going to go conservative here. -2, 0, and 2%. Profit margin. I'm going to go 8.5, and 9%. Free cash flow margin, I'm going to go 11, 12.5, and 14. PE, 8, 11, and 14. 8, 11, and 14. I think I'm being very low on 8. I probably even shouldn't. You know what? I'm not going to put 8. That's a ridiculous PE. I'm going to go 11, 13, 15. 11, 13, 15. Because, guys, the higher the growth rate, the more you should pay in PE. If 2 companies are exactly the same, one's going to go 20% a year, one's going to go 5%, you should pay more for the one growing 20% per year. So hit the analyze button. I mean, it's in the range.
Yeah, $23 today.
This stock analyzer tool does not factor in debt. It does not factor in debt. We have a low price of 15 to 20, a high price of 25 to 38. It's in the sweet spot. If they really are committed to paying down debt, like they said. I read another article recently where one of the analysts said, I think they're going to pay down their debt even further than 2.5 times EBITDA by the end of 2023. That would be wonderful. I would love it.
If I'm not mistaken, they do have a share buyback plan in place, don't they?
Oh, I'm sure they do.
I swore I read that, and it was
look it up.
Paul, for a stock that hasn't moved in like 30 years, I mean,
it has been a long time.
You're telling me that I got to buy AT&T and hope they buy back shares, reduce their debt. That's how I make some cheddar in the future. I mean, this seems like a pretty tough play on this.
Well, it can be a tough play. By the way, guys, this is the 30-year chart on 30-some year chart on AT&T. I mean, look in 2000. It hit freaking $60 a share. If I told you in 2000 that AT&T, this mega Goliath that was laying pipelines for, not pipelines, but fiber optics all over the country, would be selling for 1/3 the price 20 years later, you'd been like, you're crazy.
Well, let's not forget, Paul, that's when you and I got cell phones for the first time. So, I mean, I can imagine, you know what I mean? Like, that's a pretty big thing that happened to the world.
Yep, and they just started to take on more and more debt, made the company unattractive. But guess what, guys? As the price goes lower and lower, it might be the opportunity. That's what being a value investor is about, is seeing this disconnect between price and value. Now, do I think AT&T is going under because of debt? Probably not. But for me, as a value investor, I would rather just wait till they get the debt under control, because I'm sure it'll still be unattractive to the public at that point, and go from there.
If you're looking to trade this company, which Mo, I was going to say you can trade with Mo, but does anyone trade AT&T? Does it go anywhere?
So I'll be honest with you. This used to be my favorite stock to long-term trade.
Because your long-term trade, because
it's so damn slow. And you would be like, this doesn't really show a good graphic of it, but I'm going to draw my own lines. This thing used to go up very slowly once a year and come down, and you could write it up. You can go short on it. And it used to have 3 cycles throughout the year. And it was just so easy to trade. Now you have all of this volatility that happens where you have these big gaps up and down, and earnings sends everything everywhere. Guys, AT&T is going to eventually be a good stock that's going to be a good long-term trade. Once it gets rid of all of this news and volatility, probably when this merger's over, you're going to have an opportunity to trade this thing long-term. From any other perspective, it kind of sucks because it's real slow. Real slow.
That's your close.
That's it. I have nothing to say. It's so boring.
Well, it was just as good as my open.
Literally the most boring stock of all time.
We will update you on AT&T in the next 20 years when they buy back shares and the stock price goes up about $13 maybe the most.
Hey, that'd be a pretty good. That'd be $13 on 23. That's pretty good.
By the way, for their share buyback, they said that as they reduce their debt, it'll allow them to have flexibility of buying back shares, but they haven't laid out a plan.
All right.
Really.
So
Cool.
Fondle the thumbs up, subscribe. We'll keep you posted. Join the community. You will love the software. See you next video.